Good morning, everyone. You're all very welcome to our midweek market update. So, of course, today we have the big talking point of the US CPI inflation figures. So, CPI is going to be the big dominator today as the market participants gauge what is going to be a hugely volatile market leading event. So, this is going to be hugely important for those who are short-term traders or scalp traders, or even traders who trades news as well, for those who are positioning themselves in our community. So I suppose broadly, first things first, as we look at the broader markets this week, where are we looking at potentially this week? Well, since our call on Tuesday, we have seen market participants very much see a little bit of orientation back into risk safety again ahead of the midterm elections that took place over the last couple of days or so, and the results that are still filtering out. And of course, the Chinese CPI that came out last night, the night before, which was obviously less than expected. So I suppose the consensus today really is towards risk safety. That shift again, that sentiment, that kind of midweek reversal. We had fairly aggressive stock market movements Monday and Tuesday after the back of NFP last Friday. And of course, into the early parts of yesterday. And we're starting to see that shift and that change in dynamic and sentiment as well. So that then obviously leads us on, I suppose, the little bit of a back burner today into the FOMC, as market participants have seen the CPI figure come in less than expected or higher than expected in both the last 2 months expectantly. So what does that mean actually in a nutshell? Well, what that means in a nutshell is that the major market analysts and economists are looking for the inflation CPI figure to come down much quicker than what it is actually doing in reality. And as such, that is obviously a difficult task for the Fed within the FOMC, and obviously led by Chair Powell, in which to overcome. So it's obviously important to put perspective on things, but it's also important to actually understand the dynamics at play and how the CPI figures, whether higher or lower, will actually affect the market movements. Now, of course, if you're looking at CPI specifically, you generally want to have the CPI figure, unlike employment, unlike growth, and unlike a lot of the other economic data, to actually be lower than expected. Because in a nutshell, when the CPI figure is higher than expected, that means the prices of goods and services in the economy are higher than expected, which is generally a lower obstacle or a higher obstacle, should I say, for lower growth. And that's obviously important to recognize. So when we look at the economic calendar today, gauging towards that 1:30 economic data point out of the US. Now, of course, this is not set to GMT1. Of course, with the clocks moving back last week. So, of course, do factor in that it is 1:30 p.m., not 12:30. So the CPI figure year on year, the headline figure, 8.2%. The expectation really is anywhere between kind of 7.9 to 8%. Bloomberg are looking for 7.9. A lot of other institutions are looking for around about 8%. And we've actually published a list in our private Discord, or public Discord, should I say. We have published a number of institutions and what they're looking for in terms of the inflation figure as well. So if you want to actually take a look at that, feel free to join our Discord as well for that information. So, of course, realistically, anything under kind of 7.98% is going to be taken as a good thing for the markets, because it shows that the inflation level is actually coming down a little bit faster than forecasted or projected. So really, if you're looking for stock markets to rally, if you're looking for that weaker dollar play, you should be looking for kind of below 7.8. 7.8 and below is really going to be the marker to symbolize a shift and a turning point in those higher prices, where we're starting to see the actual effect or the addition of these higher interest rates, let's say over the last 6 months, really starting to come into play. And of course, if we struggle to break that 8% level, that just means that the prices of goods and services are remaining higher for longer, which means that the Fed are going to have to continue on its path to tackle these much higher prices in the broader market. So that's effectively kind of just to kind of give you a breakdown. Now, today specifically, the three figures that I'm looking at myself personally is the year on year at 8.2%. The forecast is kind of anywhere between 7.9 and 8%. The month on month figure, which is actually forecasting an actual increase. So 0.4%. If you look, last month, 0.4% was the projected for October. They're actually looking at 0.77% this month. So it'll be interesting to see with the higher energy prices. So oil prices, diesel prices and fuel prices, broadly speaking, have actually increased in the last number of weeks. So that will obviously impact on the energy prices and the cost of energy prices in terms of the CPI index as well. So obviously worth keeping an eye on that, because of course, if we see CPI, let's say, remaining stable at around about 8%, and we see CPI month on month going 0.7 or 0.8, that's generally going to be a negative for the stock markets. You're probably going to see the indices sell off, and you're probably going to see that sentiment again towards orientation of dollar strength. And we're going to focus on the charts now in a moment. The other aspect is to also look at is the CPI figure excluding food and energy. So when you take utilities, you take food, you take energy out of the equation, where is the averaged current inflation level within the US economy? And currently, they're expecting the price today to be somewhere around about 6.6%. So 6.6% is where we're currently at. They are looking for a broad decrease to 6.5%, which is showing a little bit of a decline. Now, over the next few weeks, we'll be assessing the CPI levels, the CPI figures, both headline and excluding food and energy. We'll also be looking at the PCE figures, because they are 2 or 3 sets of figures that the Fed look very, very closely to in terms of their mandate towards having stable prices. Okay, if you see PCE CPIs remaining very, very high, that generally means the Fed are going to be resilient in their approach to get these rates as high as possible to counteract, to actually start making a real significant impact in the price of these goods and services within the economy. So, of course, it's going to be a very, very interesting piece of price action come 1:30 p.m. But of course, we have 4 hours to go, or almost 4 hours to go. So a lot can happen between then and 1:30. So as we look at the broader markets, it's really kind of setting the tone. Now, of course, we do have a number of speakers out as well in the markets today, of course, as well. So, of course, on a side note, we have obviously published this list as well. We've got the De Guindos is out at 11:30. We have Schnabel, Casimir, and Vasily out at 1. We've got Ramsden from the UK, who's a super hawk, is out at 1 o'clock as well. And of course, in the US session, we have Fedwaller out at 7 a.m., who is obviously a hawk as well. We've got the jobless claims at 1:30. We've got Harker out at 2. We've got Logan out at 2:35, just after the open. We've got Daly out at 4. Mester, who's also a hawk, out at 5. George out at 6. And the federal budget here is at 7 p.m. tonight. So, of course, in our institutional group, if I just share that over very, very quickly so people can actually preview our Discord, we are constantly flowing through with the latest events, the latest details regarding speakers, regarding the fundamental events. So at least that way then traders have as much information as possible. Now, we know a lot of traders don't look at fundamentals, and we absolutely respect that, because it all comes down to your own trading plan. But if you are trading news, you are trading short term, we definitely feel by providing you with this information, it gives you an edge. It gives you kind of structure of what to potentially look out for. So if you are running a trade, you are aware of potentially high volatile news that could potentially take you out of your trade. And of course, again, as we talk about with the CPI estimations, we've got Credit Suisse at 7.8, we've got Barclays at 7.8, Bank of America, Goldman Sachs, Nomura, JP Morgan, all under the 8% level, with Gurgavan Capital, Jefferies at 7.9, TD Securities at 7.9, and BMO, CIBC, Morgan Stanley, Chartered, Wells Fargo, and Scotiabank all at 8% or slightly higher. So it shows that there's a wide variety. Now, of course, 7.8 to 8.1 is quite a wide range of expectations and analyst forecasts. So, of course, 8.1 on the hawkish side, 7.8 being on the dovish side as well. So obviously we're looking at that very, very closely. So of course, let's take a look at the price action as we head towards today's CPI data event. So we're obviously seeing the price action in the DXY rally, a bit of a midweek reversal kind of from yesterday off this 109.50 structural level on the DXY. So this kind of area of interest that the price action has been looking at has held quite firm. So we had this level at the end of October. You'll kind of see it there briefly. We did come down to test it. Price action has maintained above it, and we have seen a bit of buying volume in the dollar out of risk orientated assets into safety assets, and we're seeing that obviously propel to the upside as well, back above this 110 figure. So it really becomes a case of, are we going to get another cyclical move of dollar strength back into kind of 111s, 112s? Well, that will be the catalyst of higher than expected CPI figures that will push it that way. And of course, there's always price action structure developing in the background, but then the fundamental event tends to be the catalyst or the excuse or the narrative for the price action to get to a certain level. And it is very, very important to be aware of that. So as we look at the yields, we see the yields coming back off this 4.22% as well. So obviously worth keeping an eye on that. Yields, broadly speaking, has remained above the 4 4% level over the last week or so. And of course, we did get that impulse off of last Friday's NFP figure back into 4.25% before we've actually started to rumble a little bit lower. But of course, worth keeping an eye on that. Now, as we move to the FX markets, we can see that the euro dollar did get to those local highs. So kind of like with the DXY at local lows, euro dollar has got to local highs at around about 1.1. Now, this area here, this order block level at 1.1277 on the 4 hour was an area of interest that I was looking for. That is yet to get mitigated on the 4 hour. So you can kind of see how we've seen that gradual assimilation. We talked about it earlier in the week, the higher highs, higher low scenario. But now we're starting to see a little bit of an unwind, a shift in sentiment out of risk asset or risk orientation back into safety, stronger dollar. And we are starting to see that euro dollar actually sell off. So we've broken back underneath 101 again, back through parity, and is trading under parity into today's FOMC meeting. So that's going to be a very, very critical short-term level. Now, when you also look at the price action, let's say since the 7 o'clock, really kind of 7 a.m. in the UK is when you start to see the volume really start to tick up. And since then, you've actually seen that there has been that kind of shift. With 7 a.m., there's been a very, very decent sell-off. That's followed into the London Open at 8. And at 9 a.m., we're starting to see that continued sell-off. So we are creating this kind of retail head and shoulder structure. You can kind of see it there as well. But also I would be looking for that kind of break of structure, because you can see here quickly that we've got that very, very strong imbalance move to the upside. We have a little bit of a gap down. Price action fills the gap. We meander higher, flagging structure. We're now looking to see, can the price action break the structure? So in my perspective, I'll be expecting volatility today, probably in both directions. But if we can see that break of structure, flag back up to an order block or point of interest up here, and then potentially see the true aggregated move filter through, that would be a positive. But for my expectation, it'll be worth keeping an eye to see, does this short-term break of structure area actually cement into the marketplace? Now, of course, as we look at cable, cable's quite an interesting one. Of course, you can see it there. Markets continue to trend higher, higher highs, higher lows specifically. And of course, we have flagged all the way back up into this 116 handle. Now, you're probably wondering, well, what's at 116? Well, if you look at the 1 hour chart specifically, you can actually see how we've got that. We've initial highs. We've broken through the short-term structure. We've got this double mitigation or double retest of this 1550 area of interest where we had the peak wicks. We've obviously sold off. We flagged all the way back up. So all of this selling imbalance and bias and order flow in the markets has been undone as the price action returns to this 1 hour level. Now, of course, this is where the initial origins of the impulse selling starts from. And of course, that is just around that 116 level. And you can actually see, if you were to plot a line from the order block level, you can actually see it's been mitigated to the point, very little drawdown, and the markets is ultimately sold off. Now, structurally speaking, on the cable, quite a different viewpoint, because you can see here, cable has broke short-term structure or internal structure. You can see here, we've obviously had the higher highs, higher lows. Okay, we've broken through very, very clearly, and the markets is now creating new structural lows. So normally speaking, when this type of structure happens, that you do tend to see a flag back in. Now, of course, that flag back into this upside, back into kind of 115, 125 would be on the proviso that we see lower expectations in CPI. So if the CPI figure comes out 7.8, 7.7, then you're going to see that dollar weaken. You're going to see GBP USD. You're going to see cable return back into this level up here. So that's, if you're looking for that type of move in the order block level or the smart money areas, then you're looking for that fundamental narrative to support that theory. Otherwise, if it doesn't, then you're just going to see the pound against the dollar, the cable price, continue to sell off. And of course, we have seen that reaction off of this level down here at 111.50. Could we potentially be in for another move lower? Well, of course, let's wait and see. The data at 130 is definitely going to give us the fundamental narrative and the shift in price action as well. So that's where we are in cable. Of course, if we look at gold now, very, very quickly, we can actually see, structurally speaking, if you look at the 4 hour charts, price action has now mitigated this 120 level. So this 120 level that I've talked about last week in our weekend markets video over the weekend, and of course earlier in the week, during the week after the markets had opened on Monday evening into early Tuesday, we looked at this idea of 1720 as an order block level. And you can actually see how the markets has broken through this short-term internal structure. We've come all the way back up. We've mitigated with a clear wick rejection, and the price action is now holding very, very clearly back underneath this 1710 level. So I suppose from that perspective today is we need to see the narrative of, does the price action now try and break through? We've seen the order block rejection. We've seen the double mitigation. So we've seen the first phase with the correction back into this level. We've seen the second phase into equal lows. price action is very, very quickly returned back into this 1720 level. So of course, on the lower time frames, it's worth keeping an eye on the price action, because since this rejection of the 1720 handle, price action is largely drifted sideways. So you can kind of see how the price action now is in a period of what I would call consolidation or accumulation, as the markets kind of pause to wait the fundamentals at 1:30 p.m. So of course, if we see higher inflation, you're going to see the gold prices sell off. If we see lower than expected inflation, you're going to see the gold prices probably rally through, and don't be surprised to see it take out this liquidity between 1720 and 1725 if that was to happen. So where does that leave us then with the indices? Well, structurally speaking, on the indices, this is something that I've been actually following myself personally. We've had that very, very clear bullish trend since the mid-October CPIs we talked about at the weekend. We've had that break in structure. So this bullish order flow of higher high, higher low has been very, very clearly broken in terms of the order flow of the price action. We've made new short-term structured lows. We've flagged all the way back up into this region. And of course, since then, we have sold off from this 38.50 level all the way back into the 37.50 handle. Now, of course, if you look at the 1 hour charts as well, you'll kind of see this topsy-turvy effect. The price action comes back into where we had the, I suppose, the origins of volatility regarding FOMC last week. We had that impulse back into this region, price action tails off into this consolidation structure now. And of course, if you were to look at the 15-minute charts for those who trade short term, you can actually kind of see the order flow developing as well. Because yesterday we had that impulse, or sorry, Tuesday we had the impulse to the upside. Then we had the sell-off into the close. Price action came back up to consolidate. So you can actually kind of see here this kind of shorter term internal breaks of structure. You can kind of see it there, how the price action breaks through. We flag back up, rejecting this kind of area of liquidity up here. And then, of course, we drift sideways through Asia session. We initiate the breakthrough on the London Open. So, of course, London Open, we flag back up to take this short-term consolidation here. So if you're looking at this short-term consolidation, you can actually kind of see how the structure is broken through. We flag back up, and then from there, it's really just clear bearish order flow through the course of yesterday into last night's close, into what we are now holding as consolidation. So really, it's a case of how does the markets react today? 37.60 is our European or London Open highs at around about 37.62. So of course, I suppose from a short-term perspective, but also from a swing trading perspective as well, it's a case of how does this area hold up into today? Do we see price action pull back? If we see that correction, you're probably going to see see the S&P return back into this 38.20, 38.30 level. And of course, that would mean kind of a more broader area of interest. So this kind of point of interest here that's been kind of broken off the wick, you would see the price action mitigate this impulse back into this zone of interest for a potential unwind. So of course, let's just see what develops today on that one. But definitely some very, very interesting structures of price action is developing, of course. And when you see that the initial top played out with that relief rally, we could potentially see short-term highs here for ultimately that unwind. Now, of course, we had the bigger breaker structure. We've had shorter-term internal breaks of structure as well. So let's see, does this continue moving lower broadly? So that's the S&Ps. If we look at now the Nasdaq kind of similar to a lesser degree, it's kind of held this liquidity level around 10,600. You can kind of see it there on the 1 hour chart. Very, very nice impulse of move back into this region here. You can kind of see as well the order block level or the mitigation or volatility that we saw from last Wednesday's FOMC. You can actually see at 11,200, it's rejected it almost to the pip or to the point, and we've actually clearly rolled off. So again, very, very similar structure to the S&Ps. Short-term break of structure into Tuesday night's close. We flag back up, and then we've continued to grind lower in line with the bias yesterday, and markets are kind of showing that very, very similar formation. So Nasdaq, very, very similar to the S&Ps. And of course, if we do see that sell-off today in the stock markets, it then becomes a case of, can we break this liquidity level here between 10,650, and realistically you've got this shorter term 1 hour area of interest, this order block from just after last Friday's NFP being a potential level at around about 10,680. So if we're breaking through this, that's the indication that probably the indices are going to continue trending lower. But of course, let's wait and see, because we could get a sharp move lower and then get a recovery as well, because we do have an order block level down here as well from a liquidity standpoint. So where are we now on the Dow Jones? So the Dow Jones has been very, very clear. Okay, so if you look at broader perspective, Dow Jones has rejected this kind of 33,200 level. We had the initial impulse. Again, you'll notice how the wick refuses to take out or close above this order flow level here. We have obviously the wick highs at 33,463, clear rejection, price action consolidates, and then we initiate an impulse lower. Now, again, when you look at the DXY in the 4 hour, you can start to see the flagging structure develop. So very, very sharp impulse, flagging structure, new lows, new highs, price actions creating that corrective move. So we could see this kind of move develop in Dow Jones where we get, let me just get my icon, where we get that pullback, then we get new highs, then we look for the break of structure, we flag back up, and then look for the unwind back down. So that could be a potential scenario to look at for those who are trading liquidity, those who are watching the broader moves, not just kind of those short-term impulses beyond the fundamental event as well. So from my perspective as well, if you're looking at the Dow Jones, very similar move on Tuesday, sharp move run up higher, obviously completely catapulted back into the downside under this 33,200 area, consolidate into Asia session, and then similar to the S&Ps and the Nasdaq, we had that consolidation, break of structure, price action flags back up, doesn't fully mitigate the 15-minute level at 33,145, but just ultimately tames off, sells off, and that's a very, very clear 500 to 600 point decline in the Dow Jones. So even if you're taking that at kind of 3 to 4 lots or $4 per point, you're still making kind of $1,500 to $2,000 on a very, very simple trade there. So it's all about risk. It's all about understanding the principles of the price action and then being able to apply a clear logic broadly beyond that. All right. So as we move to the last two now, we've got FTSE, which is still technically continuing this bullish trend broadly. So we've got higher highs, higher lows. So higher highs, higher lows, higher highs, new higher lows again. Markets is trying to take this higher. So this order block level around about 74.60. So it's really kind of the daily area comes in bisects at around about 7,400. The 4 hour zone of interest is going to come in here around 74.50, 74.60. So from my perspective, really just watching the price action at this region to see if there is that third. We've got the breakout. We've got the first pullback, second pullback. Can we get that third move higher and get that completion and an end of this phase of liquidity that has developed from mid-September? So that's something to look at there on the FTSE. Shorter time frames in the FTSE, we did have AstraZeneca news out today, which was better than expected, which did see that short-term wick higher on the FTSE, but you're really looking at FTSE taking out this 7,300. If you're taking out the 7,300, 7,315 level, we should be looking really at the price action continuing with this bullish elevation of price action. But of course, you could see wicks, so it's important to ensure that if the move does initially occur, making sure that move is sustained and you're not buying the high ultimately for the price action to unwind back on yourself. And then, of course, last but not least, on the DAX, structurally speaking, order flow is still very much continuing to the upside, which is positive for those who like bullish bias in the DAX. This order flow from August, that initial impulse is still obviously trending lower into these October lows or end of September, October lows. This order block here from mid-September has been mitigated as the price action is completely broken through. So you can kind of see how the price action comes up initially, then we break through, we continue elevating to the upside, and you can kind of start to see the flagging structure. So the flagging structure develops at kind of the latter end of the stage. You'll either see the flagging structure or you'll see accumulation structure. So they're kind of the two identifiers to kind of watch out for after or kind of close to the end of a trending impulse. And you can kind of see there now we're starting to see a flagging structure. But from my perspective, we've got a daily level and we have got a 4 hour level up here as well. And they are the two levels of interest that I'm looking at. But of course, just watching the price action to see if there is a reaction. Now, of course, I do have alerts, or I am setting alerts, should I say, at both of these levels to make sure that if the price action does get to them, I'm being informed ASAP. All right. So that's pretty much where we are for the minute, folks, into CPI today. So I would advise caution at all times. So trade safe, trade well. Of course, best of luck for those who are trading today in the midst of the CPI data. And of course, we'll see you all tomorrow for the weekly roundup. Have a great week, everyone.